One of the common questions or common challenges in doing valuations is to understand the impact of the extremely low interest rates that we've been experiencing on the valuation of companies. Because when we value companies, we're focusing on discounting the cash flows at some cost of capital. So what's that cost of capital? And has it been influenced by the low interest rates? You would expect that as government bond rates have gone down, that the cost that equity shareholders demand from investing in equities would have also gone down. But the empirical evidence shows otherwise, right? Despite the fact that government bond rates have gone down substantially and have stayed down for a decade, the cost of equity has remained constant. And the way we've estimated this is we reverse engineer share prices. We take a broad index like the S&P 500, and we think about what are the reasonable future scenarios about profit growth, returns on capital, and the current share price. And we say what cost of capital would allow us to come up with that share price. And what we find is that the cost of capital that allows us to come up with that share price, let's say for large US companies right now, is about 9%. And with about 2% expected inflation, that leads to a real cost of equity of about 7%. We've done this analysis going back over 50 years, and we found that the real cost of equity by reverse engineering share prices is traditionally been about 7%. So the decline in government bond rates has not changed the cost of equity. This makes sense because investors cannot lock in the cost of equity or the return on equity, right? If interest rates were to go up tomorrow, right, then, and the cost of equity were to be tied too closely to government bond rates, then equities would decline, right? And so investors are very skeptical or very concerned about using too low of a discount rate when thinking about equities, because you don't want to make an investment and then tomorrow when interest rates change, that investment is now worth a lot less than it was before. You can also look at it and say, what would the market look like if, in fact, the cost of equity had gone down substantially? If the cost of equity had gone down in line with the decline in government bond rates, what we'd expect to see is that the typical large company in the US or Europe should have a price earnings ratio well above 25, right? Just by the way the math works. And yet that hasn't happened, right? Price earnings ratios have remained fairly constant over the last 15 years throughout the Great Recession, just prior to this crisis, and I'm probably sure just after this crisis. So price earnings ratios gravitate back to a level of, say 15 to 17 times earnings, which is roughly consistent again with that 7% real cost of equity. So there's a lot of evidence that says cost of equity hasn't changed. So companies still have to earn the same returns on their investments in order to satisfy their shareholders. And in fact, most of the companies that we talk to and we work with, we find that they have not reduced the rates that they expect to earn when they evaluate investment opportunities. So companies and investors and bankers, everyone is using pretty much the same cost of equity that they were using 15 years ago, before the housing crisis, before the financial crisis, before the corona crisis. That doesn't seem to have changed. That seems to be fairly stable over time.